According to an article from Business Insider, the price of lumber has increased 250% over the past year. Homeowners are actually getting cold calls from prospective buyers asking them if they're interested in selling their home. With trillions of stimulus dollars floating around an economy that is marching full steam ahead as the world begins to reopen, the prices of goods and services are rising substantially. How much inflation can the country afford before we're in serious trouble? Stick around, let's find out. Hello and welcome to another video from One Up Financial. I am your host, Eric Persagna, here to help you increase income, reduce taxes, and invest smarter in retirement. Is inflation something that you should be concerned about? Before I address that question, let's kind of just dive into real quickly what inflation is. So if you've noticed the price of a good or service rise over time, that's inflation at work. Economists use the broad increase in the price of goods and services as a broad measure of the overall health of our economy. So when inflation is stable and predictable, it's a sign that our economy is doing well. It's relatively healthy. But high inflation can quickly eat away at our purchasing power and indicate that the economy might be overheating. On the other hand, deflation, or the decline in prices, could indicate that the economy is shrinking. Now, based on some recent economic data that came out last month, I think a lot of economists were surprised to see that inflation increased much higher than they expected. Could this be a sign that we are going to see an increase in prices and inflation for the next several years that could potentially result in a recession? That is definitely a possibility, and I think something that people are very concerned about right now. So when you have this inflationary risk that's going on right now, it's common practice for the federal government to step in and raise interest rates. And they do that because they want to help stabilize the economy and prevent it from overheating. The problem right now, though, is that the federal government has said on multiple occasions that it does not intend to increase interest rates at least until 2022 or 2023. The reason for that is they believe that the increase in prices we're seeing right now is more transitory in nature, meaning it's more short-term and it's more of a result of the US economy coming out of the global pandemic. So it's kind of us trying to get back on some path towards normalization. Let's look at that data that came out last month. So the Consumer Price Index, or CPI, is a broad measure that most economists use to gauge inflation. And last month in April, the CPI figure was much higher than what most projected it to be, which caused a lot of people to be concerned that we're going to see this runaway inflation. But if you actually dig deeper and look at the numbers that comprise that CPI figure, you'll see there are really only two components that drove CPI higher last month. Those two components, one were transportation services, and two, used cars. And if you think about it, it kind of makes sense, at least with transportation. So in 2020, everything was pretty much offline. No one was traveling anywhere. Prices were near rock bottom. Now, as the world is reopening and people are getting out of their shell and they're going out and traveling more, you're going to see the prices of flights and rental cars go up substantially, and that's kind of what we're seeing. So that makes sense that that was a huge component of what drove CPI higher. Used cars, on the other hand, were kind of interesting in that if you look at the market for new vehicles, there is currently a global supply chain bottleneck with everything from just raw material parts to semiconductors. So it's much harder for some of these car companies to manufacture new vehicles, which in turn is causing a lot of consumers to go towards the used car market because they can't get the new cars that they want. So I think that if you look at the CPI figure and if you kind of break it down from that standpoint and you look at it as a whole and say, okay, just based on the data that we saw in April, is that really something that we should be concerned about regarding a sustained inflationary risk going forward. In my opinion, I don't think 1 month of data is enough to be overly concerned about inflation, sustained inflation going forward. And especially when you kind of break down the components of that CPI figure, you'll kind of see that they are, as the Fed said, more transitory in nature. They're more a result of the US just kind of coming back online and coming into a more normalized state. So in general, I don't think that sustained inflation is something that we should be overly concerned about going forward. I do think that inflation is something that we're going to want to pay attention to in 2021, especially considering that there is still a lot of stimulus money floating around in the economy right now, in addition to the upcoming monthly cash payments that the federal government is going to be sending out to those with children as an advance on the child tax credit. So there's a lot of money still floating around. There is unemployment benefit bonuses that are still out there. So a lot of people still have a ton of money saved up from the pandemic. And as the world opens up, you're gonna see those people get out there and start spending. And that's just gonna cause prices to go much higher, at least until the supply chains can start coming back online and kind of balance out the demand. So bottom line, I do agree with the Fed's stance in that the inflation we're seeing now is more short-term, it's more transitory in nature, but I do think that short-term is very important to define because it could last well into 2021, if not early into 2022. Thanks as always for watching our videos. If you're interested in keeping up with market updates, blogs, videos, other financial commentary that we release, please feel free to subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.